My name is Charlie, and on this channel I make videos about wealth building and achieving financial freedom so that you can free up your time to focus on the things that you truly care about. As a stock trader, it's important to have strategies under your belt that you can use in all markets, whether stocks are rising, falling, or staying neutral. So covered calls are great and they do work in all markets, but what if there's a way that you could add to the premiums you're bringing in without putting down any additional capital up front? Well, you actually can, and you can do it by setting up something called a bear call spread, which is otherwise known as a call credit spread. Now I'm sure some of you are familiar with these, but for those of you that aren't, here's how they work. As the name implies, it is a spread, meaning that you're going to buy one option and sell another option on that same stock. So in the case of a bear call spread, you're going to buy one call, usually very far out of the money, then sell a call against that one at a lower strike price but with the same expiration date. So to make things simpler, we'll refer to the call we buy as the long call and the call we sell will be known as the short call. So the long call will be cheaper than the short call since the long call is further out of the money and therefore you're bringing in a net premium by setting up this spread. So let's look at some hypothetical numbers here to help it make a bit more sense. So let's say we have stock XYZ here that's currently trading at $100 per share. And the most important thing here is that as with every single trade we make, we only want to do it on a stock that we believe in for the long term and wouldn't mind owning. Because even though this is a bearish trade and we're going to do it on a stock that we think will stay neutral or fall in the short term, there's a chance that we'll end up owning the shares, so we only want to do it on a stock that we think will rise long term. So in order to set up a bear call spread on stock XYZ, we're going to buy the 130 call that expires in, let's say, 3 weeks. And it'll cost us around 20 cents to buy that call. Now we're going to sell a call against that one at a lower strike price to collect our premium. So let's say we'll sell the 108 strike call, again with an expiration date 3 weeks out, and we'll collect a premium of $1.80 for that sale. Now again, these are hypothetical numbers, but this is roughly what you can expect these options to cost, of course depending on the volatility of the underlying stock. So at this point our spread is set up, and without even buying the shares up front, we've brought in a net premium of $1.60, which is actually $160 because of course options are bought and sold in 100 share increments. So you're probably wondering now what happens from here. Well, there are a few different scenarios depending on what happens with the stock price from now until expiration. So let's start by looking at the actual implications of these calls that we've bought and sold. By buying the call at the 130 strike, we're actually buying the right to buy 100 shares of XYZ at $130 if it hits that price by the expiration date. And by selling the call at the 108 strike, we're selling the right for someone else to buy 100 shares away from us if the stock hits $108 per share by the expiration date. So this means that the short call does have an assignment risk to it, because if that stock ends up above $108 at expiration, we have to own 100 shares in order to be able to cover our end of the deal. So when you're looking at possible outcomes, there are really just two scenarios that we have to consider. Either the stock ends up above the 108 strike price and you have to deliver the shares, or the stock ends up below the 108 strike price, so the calls expire worthless and nothing else happens. And of course, in both cases, that initial premium that you collected never goes away, so that's always yours to keep. And this is why this strategy is so great in bear markets, because you can collect that premium without initially owning any shares, and if the stock doesn't rise, then you never have to own the shares. But of course, when it comes to any trade, you should always think about what might happen if things don't go the way you expect. So in this case, that would be if the stock rises between now and the expiration date of the spread. Well, as we know, if our stock XYZ rises above that 108 strike price, we'll have to own 100 shares of it, since we've committed to selling those 100 shares if the stock hits 108. But here's what makes this trade so powerful, because rather than waiting for the call to expire, then picking up the shares and potentially having to sell them at a loss, you can just place a buy order at the time of setting up the spread, which tells your brokerage to buy the shares as soon as they hit a certain price. So I'll usually set that price at around 50 cents to $1 below the strike price of the short call. And for the sake of this example, I'll use $1, so we'll set up a buy order at $107. And of course, you want to set up that order to buy 100 shares. So this way, as soon as the stock price hits $107, I'll automatically buy those 100 shares, and you'll find that most of the time, the stock will continue that momentum and keep rising into the expiration date of the spread. So then when the spread expires, you'll get called out and have to sell your shares at 108 and the trade will be completely over. So as a nice little bonus in that case, in addition to the initial premium that you brought in, you also just brought in $100 worth of capital gains by buying the shares at $107 and then selling them at $108, which brings the total profit from this trade up to $260. Now you may also be looking at this and saying, well, what if the stock hits 107 so I buy the shares, then before the expiration date the stock drops again and now my short call is out of the money. And that can happen, although it's pretty unlikely if you set up the spread correctly, which we'll talk more about shortly. But essentially at this point you're just left in a covered call because you own the shares and you have an out of the money call sold against them. So it may seem like a less than ideal situation at first glance, but if you're making this trade on a stock that you wouldn't mind owning for the long term, which again you always should be, then it's not a bad situation to be in at all. Again, just to really nail that point down, the worst case scenario is just that you end up in a covered call with a stock you like, and even that is pretty unlikely to happen. Most of the time when you set up this trade, you'll either end up collecting the premium without ever having to own the shares, or you might have to cover the shares, but you'll immediately get called out when the spread expires. So hopefully that hypothetical example helped to nail down the fundamentals of this trade, and now we'll get into a real world example of how this would be applied in the market today. Now again, the ideal candidate for a bear call spread is a stock that we think will rise long term, but stay neutral or even fall in the short term. So at the time of filming this video on November 6th, 2020, I think Apple is a decent candidate since it's been pretty neutral over the past few weeks, and I don't really see it zooming higher until there's a little bit less uncertainty in the market. So let's pull up the option chain on Yahoo Finance, and for bear call spreads, I like to set them up about 2 to 4 weeks out, so I usually just go with 3 weeks out as a good sweet spot. So that brings us to the November 27th, 2020 option chain, and we'll want to look at the out of the money calls for that date. I usually start by looking for the short call, again the one that we're going to sell, and I like to go at least $6 to $10 out of the money there, so that way as long as the stock stays relatively neutral for the next 3 weeks, I'll be able to collect my premium without ever having to own the shares. Apple is currently trading around $118, so I like this $1.19 premium here for the 125 call, which is about $7 out of the money. Now we just have to look for the long call that we're going to buy, so for this I like to look for a premium that's about 10 to 20% the size of the short call. In this case, 10% of that $1.19 premium would be about 12 cents, so the closest we're going to get here is this 13-cent premium at the $140 strike. So there's our spread. We're going to go into our brokerage account and buy the November 27th 140 call for 13 cents, then sell the November 27th 125 call against it to bring in that $1.19 premium. Therefore, our net premium received for setting up this spread is $1.06 per share, which is of course $106 total. Now the last thing you have to do is set up your automatic buy order to cover the shares in case they do rise in price. So in this case, we'll want to set up a stop order to automatically buy the shares as soon as they hit $124. You can choose whatever price you like, but as I mentioned earlier, I do like to set up the buy order about $1 below the strike price of the short call, so that way if the shares do rise significantly, I'll also bring in an additional $100 worth of capital gains. So I know this is a lot to consider if the spread is new to you, but if you watch this video a few times and perform the trade once or twice, it'll start to make a lot more sense and you'll see how powerful it can actually be. So now that you know how to set up bear call spreads, if you want to see why I don't think you should be using the wheel strategy, be sure to click that video in the bottom right corner of the screen. So there you go. I'll see you all in the next one.